So we have problems in Portuguese banks. We have problems in Italian banks. The ECB cannot print the amount of money required to bail out all of these banks. So obviously the banks are talking about, the European Central Bank and the different banks are talking about trial balloons of either nationalizing banks, bail-ins, bailouts, going after pension fund money, etc. But ultimately, this is going to have to, the only real central bank that has the type of ability to create money and credit out of thin air with hardly anyone even noticing is the Federal Reserve.
Hi, and welcome to the X22 Report Spotlight. Today we have a returning guest, Jason Burek. Jason is an investor, entrepreneur, financial historian, and an Austrian school economist. He co-founded the startup investor education and financial education company, Wall Street for Main Street. And I am very happy to have him back on the X22 Report Spotlight. Jason, welcome back to the Spotlight.
Thanks, Dave. I'm glad to be back. You do great work.
Thank you. So do you. I really like your channel. I like the people that you interview. And for those people who don't know, he has a YouTube channel called Wall Street for Main Street, and you can go right over there and you can take a look at all of Jason's interviews. Let's start off with the European banking crisis. We're hearing a lot of talk about the Italian banks. We're hearing talks about Deutsche Bank. And where do you think this is going? Do you think we're at a Bear Stearns, maybe a Lehman type of moment with these banks?
Yes. Now, I don't know if it's going to happen in the next couple of weeks or next month or so, but the next 6 to 12 months, we're certainly along that path. I think it's imminent. Now, in terms of Deutsche Bank, I think a lot of people know about Deutsche Bank. Deutsche Bank basically is a black hole. And, you know, if you know about science and a black hole, it just sucks things into it, right? Just it's gravity. And so Deutsche Bank has just this enormous over-the-counter derivatives exposure in the many, many trillions, tens of trillions in derivatives exposure. It's even larger than JP Morgan, and it's a smaller bank in terms of, you know, its assets. But it's just so big that, you know, no other bank can really buy it, and no government can really fully save it. You know, the German government couldn't really fully save Deutsche Bank. They might end up nationalizing it and creating, you know, putting the assets into a bad bank. But I think this banking crisis, like you mentioned earlier, it's not just Deutsche Bank. So I did a video on the Wall Street for Main Street channel either last week or the week before about detailing the different stories on zero hedge of all the different European banks. So, you know, there's other German banks that have problems with their derivatives exposure, with the Brexit crisis, with the British pound having just enormous instability and things like that. And their loan book is going bad. So we could just talk about different European countries. I could just name them. So we have problems in Portuguese banks. We have problems in Italian banks. There's potential bank runs there from what I hear from sources with Italian banks. And then we have, you know, Banco Santander. Banco Santander is a stock that, you know, a lot of banking experts weren't predicting that this was going to be one of the really bad banks initially to at least start off with. But hedge funds are now really shorting this stock because Banco Santander got greedy. So I was covering this stock when I was a regular investment analyst at Investing Daily, covering dividend stocks and emerging markets and things like that for a short period of time. Banco Santander grew out their emerging markets loan books, enormous amounts of loans. They opened a lot of branches the last 10, 15 years in South America, in Latin America, Central America, also in the South in the United States, in Latin populated areas like Miami. They've just been giving out massive amounts of subprime auto loans, and that's why a lot of hedge funds are short Banco Santander. And they actually failed, Banco Santander did, the Federal Reserve's low bar stress test. So you know it's bad because the Federal Reserve stress test is very, very low in terms of the ability to pass it. It's very, very low requirements, excuse me. So I think there's what Banco Santander is saying is they're basically a proxy for South America and subprime auto loans because of how big their loan book grew. They were actually touting for years and years how good of exposure they had to South America, to the growing consumer there, and for commodity producer loans there, and energy infrastructure loans and different infrastructure loans and things like that. So their loan book now is going in total reverse. So they were touting all the growth they had to that emerging markets, and then now that thing's going in reverse. So yeah, I mean, we could just name the different European countries and the banks that are the banks in these different European countries. So I think what this is coming down to, and have you noticed that the chief economist for Deutsche Bank has actually been lobbying now on mainstream financial media through both print and Financial Times, and also, on Bloomberg, CNBC, etc., going on there saying that the European banking system needs 150 billion euro bailout immediately. Well, here's the thing. That number sounds large, but if you gave Deutsche Bank all that money, that wouldn't fully prevent Deutsche Bank from having problems. Deutsche Bank, maybe that would buy Deutsche Bank a certain amount of time, but that wouldn't help any of the other banks. Maybe they would split that money in certain amounts, but it just really would be putting a Band-Aid on a mortal wound. So I think, Dave, in terms of the European banking crisis, people were expecting crisis in other areas first. They were expecting either Japan or China, but the European banking crisis, possibly Brexit and some British pound derivatives have triggered it. But I think the European banks had exposure to South America, which is going bad with low base metal prices, and also bad consumer loans and other things like that are also related to, commodity prices falling for a while. So I think what's going to have to happen is the European banking system is going to need a bailout. This 150 billion euros that the Deutsche Bank economist is talking about is nowhere near enough. It could definitely buy time. It could, stop the shorts. We've seen the banks come out with additional plans of coordinated share buybacks and increasing dividends with Federal Reserve approval to stop the shorts and delay the collapse of their banking stocks. But this is not going to stop things further. This is just going to delay another potential Lehman or Bear Stearns. What's going to happen, though, and I've talked about this, many, many times since 2014 when my sources brought me the information about currency swaps, the ECB cannot print the amount of money required to bail out all of these banks. So obviously the banks are talking about the European Central Bank, and the different banks are talking about trial balloons of either nationalizing banks, bail-ins, bailouts, going after pension fund money, etc. But ultimately, this is going to have to, the only real central bank that has the type of ability to create money and credit out of thin air with hardly anyone even noticing is the Federal Reserve. So they will do, I think, enormous amounts of currency swaps. They've already put, according to Jim Rickards, over 30 trillion in currency swaps globally, just to keep the system going. Since 2008, we're going to need, at least another couple trillion just to prevent the European banking system from imploding in the next 6 to 12 months. And the Federal Reserve, on their $4 trillion balance sheet, I don't think that they're even going to declare any of this. The American people, for the most part, is not going to be made aware. Another reason I think of the European banking system, Dave, is also collapsing, and this is something globally, is we now have over $12 trillion in negative interest rates. And these large European banks, they have enormous bond portfolios that often they're the only buyers of the bonds because the governments, in exchange for protecting them, they force the large banks to be the primary dealers and buy their government bonds at almost any price. But as long as the banks were making a decent return on the bonds, they were doing fine. At negative interest rates, the banks don't get a good enough return. So I think that's also another reason. I think there's multiple reasons for Deutsche Bank having problems and the European banking system also having problems. But yeah, there's a lot of discussions around European politicians, European Central Bank, and European banks about all the different options on the table, and they're discussing going after pension plans and bail-ins and bailouts. None of these things at a bank scale or a small individual European government or even the ECB are a large enough scale. The Federal Reserve will have to at some point step in. They're probably already doing it. We don't know how much because these currency swaps are so covert, they're so backdoor, they're so, opaque, they're not transparent at all. So I think, people who are trying to time this, if you're planning on shorting the banks and, Deutsche Bank's going to go to zero in the next month or two, I would be careful about that. If you are going to short the banks, I think you need at least 6 to 12 months to let this play out. But timing of these things, there's a lot of hedge funds betting on this, is going to be very difficult.
So, I mean, from what you're saying, you're thinking that they'll be able to keep this going by all these currency swaps and the Fed creating this currency out of thin air. You think they can keep this going for what, another 6 to 12 months?
That's a possibility. Yeah, if I had to give an educated guess, I think they would let things go maybe after the U.S. election, and then maybe, if Trump wins the election, they could blame it on Trump,
Yeah.
and then he gets one term, and they say, oh look, Trump won the election, and then he let all the banks fail, and none of his policy worked, and the Republicans in the United States Congress, it was their fault too. And then, the Democrats would take control over it, and they would say, oh, we need more regulation, and oh, we need to create more government agencies. And Larry Summers is already championing for massive amounts of new stimulus plans for infrastructure projects. He wants to make the FDR Make Work projects, the New Deal projects that FDR and the other Keynesian economists back then created. He wants to make those look like tiny, minuscule projects. So they're talking about, massive amounts of new inflation with infrastructure projects, which would reflate asset bubbles and create massive amounts of new inflation.
So we also see Bernanke. He's out in Japan, and he's discussing with Abe and Kuroda about helicopter money. And we see that this might be a problem in Japan. I think it's against their laws to do this, but it looks like they're setting this up to be a pilot program and then extending it, if it works out, to other countries. What's your take on this?
Well, first off, let's talk about the Japanese yen, because I think this is one of the main reasons why the Japanese central bank and the Japanese government are panicking so much. Mm-hmm. Okay, the Japanese have tried with Abenomics to drastically devalue the yen. The same goes with mercantilism, and Keynesian economics is a derivative of mercantilism. At least it uses parts of mercantilism, is to devalue the currency, boost exports. Consumers won't hold their savings then. They'll start spending the money because they know they're being devalued. And the Keynesians and mercantilists believe that this is good for the economy. What has happened, Dave, really in the last year or so is, surprisingly, the Japanese yen, despite all of these monetary and fiscal policies from the Japanese government, Japanese central bank, the Japanese yen has strengthened. Okay, so the Japanese yen went from the 120s down to below 100 on its exchange rate against the dollar, and this has really hurt Japanese exporters. I think one of the main reasons for that is the yen carry trade, which is this leveraged speculation and investments that billionaires use, hedge funds use, Wall Street investment banks have used to invest in other markets and get rich quick, that this trade is unwinding. So there's been many, many billions of dollars in yen carry trades that have been unwound. And in order to pay off their debt, because they borrowed Japanese government bonds very, very cheaply. They borrowed Japanese government bonds, and they could pay it back in cheaper yen because the Japanese government bonds just keep getting devalued. So what has happened, though, is that these yen carry trade players are closing out their trades because they think a lot of stock markets all over the globe are overvalued. They don't like negative interest rates. They're worried about a potential bond market crash. And so they've been closing out the yen carry trade, and all that yen that was all abroad to fund other trades has started to come home, strengthening the yen and paying off debts and things like that. Because the Japanese investor really doesn't invest in a lot of equities. The Japanese investor mostly just holds cash and also buys bonds. Although now they're starting to buy physical gold because they're getting worried. We heard, 6 months, year ago that they were buying safes and starting to put yen there, but it's just crazy. So I think the strengthening Japanese yen that has surprised a lot of these Keynesian economists, they're panicking. And you brought up Ben Bernanke. They invited Ben Bernanke to go there, and he's speaking with the head of the Japan Central Bank and also Abe, so Kuroda and Abe. And what he's telling them, and this is what the Keynesian solution almost always is, and Paul Krugman says this on TV all the time, Keynesians like Larry Summers say this all the time, they didn't do enough. So their solution is, oh, well, we tried this money printing or quantitative easing or whatever they call the program. We didn't do enough of it, so we have to do more. That's why it failed. We didn't do enough of it. So what the new proposal is now is for a 10 trillion yen stimulus plan. So this is just an enormous amount of stimulus. They're hoping that they can get the dollar-yen exchange rate. It's moved a little bit, obviously, but they're hoping that they can get it way past 120 to 130, 140, maybe even 150. That would also help rapidly devalue their debt. So they want a weaker currency. They want to force their Japanese savers to spend more of their currency. They believe that that will be good for the economy, and they want to devalue their debt in real terms with a devalued currency. That's a solution that everyone wants. Will it actually work? I don't know, but this seems to be the solution that they always want to try. So if they do implement this program, Dave, with the amount of money, the 10 trillion yen, and it doesn't work, they might even just go bigger. They're also floating the trial balloon to where the Japanese central bank buys up all the outstanding Japanese government bonds from the private sector and just gives people more currency, and then changes the duration of the bonds to 100 years and basically just inflates all the value away. So that would be highly inflationary. There's basically all these major economies, the developed countries, have been acting like emerging markets countries in the past. So they have enormous amounts of debt problems that normally emerging markets countries have had. And so what they're going to do, whether this Japan, China now with its debt problem, the United States, Europe, England, they're going to attempt to drastically devalue their debts going forward. I don't know if it will actually work. What we have now is an attempt at the people who were speculating on assets to close out certain asset prices and move into either cash or gold or certain types of bonds. People are willing to take negative interest rates. So I don't think the central bankers are going to get what they planned, and I think they're going to do something even dumber, especially in Japan going forward, because Japan has the worst debt to GDP, at least when you don't count the unfunded liabilities of the U.S.
I mean, here in the States, we're seeing bubbles all over the place. And I talk about housing. I talk about student loan bubbles, the stock market bubble, the derivatives bubble, the treasury bond bubble. And here in the United States, the Fed came out with their beige book, and they pretty much said that the economy is doing okay. Housing looks good. It's getting stronger. Retail's getting stronger. And the question is, do you see bubbles in all of these areas? Housing, do you see it in the student loan market, the auto market, the bond market, the derivative market? Do you see bubbles in all of these areas?
There are a lot of bubbles in all of those areas, basically. But what I would say is that the government economic data is basically pure fiction at this point, propaganda. Now, obviously, there's going to be a few good data points here or there, like the labor participation rate, which is, at multi-decade lows here in the United States, which seems fairly accurate to me. But obviously, the GDP is false because it counts a lot of government spending and consumer spending as positive for the economy, and it doesn't count savings and investment, which actually fuel economic growth. People going into debt that they can't pay back is not good long-term for the economy. Maybe it's a tiny little pop, but that's the way the GDP is created. So all these government numbers are basically heavily spun. I'll give you a funny story about this, and this is from an emerging market country that most Americans and Europeans wouldn't trust the government numbers or would be highly skeptical of them, but their own governments are doing the same thing. My friend Nolan Watson, who runs Sandstorm Gold, him and his wife they love to go do charity work for about a month every year during the summer. They go to Africa, and they've set up a school there that they paid for, and it has computers, and the kids there are learning, valuable skills to get jobs and get themselves out of poverty. It's in Burkina Faso. Which is a very, very poor country, although their economy is starting to grow because they are getting more investments from mining companies and resource companies and things like that. But basically, when you're on the ground there, boots on the ground in Burkina Faso, walking around as a foreigner, it's common knowledge just by speaking to locals or seeing with your own eyes that the unemployment rate of adult men and women that want to work, that want to have a job, is 60% or larger. There's just a lot of people around, from hearing from my friend Nolan Watson, a lot of people around sitting all day who want a job, who have some skills, but can't find work, so they just sit around all day. And yet the government employee statistics in Burkina Faso, the unemployment rate, Dave, is below 5%. So we have a situation here where if you actually go to the country, you're a foreigner, you go to the country objectively, you walk around, you talk to the locals there, ask them about the employment situation, if people can get jobs, if the economy is really growing as well as people are saying. Maybe the economy is growing, but it's starting from a low base. But it's not the 5% or less unemployment that the government is stating when you see all these adult men and women sitting around who want a job but can't find one. So that's the situation we have now in the United States, in many different countries, where the government is putting out statistics like this saying, oh, unemployment is low. Oh, the jobs numbers, we're creating hundreds of thousands of jobs a month. We're creating jobs in retail. But look at the conference calls of Target. Listen to the conference calls, read the numbers, read what the CEOs and executives are having to say. They're not hiring anyone. Kohl's, Target, when I walk into Target, they're automating. So they're looking to fire people. Maybe if they do hire people, they are hiring a bunch of part-time people and getting people off the full-term payroll so they don't have to pay Obamacare tax and all the extra taxes. So I think, the reality, when you look at the conference calls of the company and their economic data that the companies are putting out, is totally different than the company numbers. And you can see this in the retail sector, where in the past, year or so, the government has been saying, Bureau of Labor Statistics, that, oh, we're creating jobs in retail. Oh, we're creating jobs in oil, right? Mm-hmm. And if you look at the companies themselves, they're firing tens of thousands of people left and right. And maybe they're hiring a few thousand of those back part-time.
Now, you mentioned oil, and we're continually see oil, it's dropping in price. It moved up a little bit, but it's still very, very low. Where do you think oil is going right now? Do you think it's going to start moving up once again, or do you think it's going to continually move down?
I think oil is going to be a wide trading range with a lot of volatility. I think oil had a nice rally. When oil hit around 29, there was just so many people that were pessimistic about it about 8 months ago about it. And I think it was due for a rally then. I was correct about that. So if you bought then, there was blood in the streets. It was good for a speculator standpoint or value investor, or companies that had good balance sheets that could survive that and would benefit when the oil prices started to rise. I think, we got to a point in the mid-50s of oil where people had just started to get too bullish again. What I've been noticing is that a lot of the shale producers, even the ones that are basically insolvent, have been able to raise money somehow and also keep pumping records amounts of oil. So even the ones that were in bankruptcy were still producing record amounts of oil. There wasn't a massive cut in the oil production. There was a massive cut in CapEx, which is future oil production, spending on drilling and exploration and things like that. We've had over $200 billion cut in that. So I think the oil price had it had a nice rally, which I saw was going to come at some point in 2016. I think oil may go back down. If oil price does go back down, though, we do have oil prices hedging, but there are oil companies still with really, really bad balance sheets. We're going to see mergers and acquisitions because companies are going to say, you know what, I'll sell out for pennies rather than going bankrupt. But we're going to see a lot of bankruptcies if the oil price gets to 30 or lower again, and that's a real possibility. The only way, Dave, that I see a major spike in oil prices is if the dollar is drastically devalued, and let's say the petrodollar agreement were to bust open, and there were to be immediate stoppage of the petrodollar, or there were to be massive amounts of bankruptcies of large oil producers, maybe an entire country like Venezuela go bankrupt, and a lot of production comes offline. So I don't really see a situation where the oil price is going to massively spike unless some of those factors occur. There's either a radically devalued dollar or huge supply cuts, way more than the market's expecting. But right now, we're actually seeing in the last month or so, we're actually seeing massive amounts of oil production come back online. There was the largest increase in oil production this week in about a year. So, and we've had just record amounts of distillates come online in the last 10 weeks. So we have signs that the oil industry is desperate to keep pumping again, even if they're not making a profit to pay off debt and buy themselves more time. I don't think this is good for a huge oil price spike in the near term. But, if we do have a lot of bankruptcies, we could. So I would expect for your listeners, if you're investors or traders out there, how to apply this, I would expect massive amounts of volatility in oil. We've had massive amounts of volatility in oil for the last couple of years. We could see oil price drop again to $30 or less, and then go right back up to 60 and then drop again in a matter of months. We could see these fluctuations in, 2 to 3 month spans, and it could just really have people scratching their heads. But with so much financial engineering and so much liquidity out in the system now, with these high frequency traders and people having access to so much capital that they can borrow, with the 30 trillion liquidity floating around, God knows where it's going. The oil market's going to have really crazy swings like this going forward.
Okay, let's move on to the Brexit and what happened in the UK with the EU. And we know there was an advisory referendum. The people decided, something, we don't want to be part of the EU. Even though they're still part of the EU, they haven't gone to the next step. Um, do you think at this point the UK is going to actually leave the EU?
I think there's a lot of people who didn't like the outcome of the vote. There's an enormous amount of brainwashed people who have been through government schools for decades, who have listened to the mainstream media in their own country in England and also the American and international media for decades that say that, you know what, I want to be with my European brothers and sisters. Nigel Farage, who was one of the main champions of Brexit, he didn't even think it was likely that the Brexit vote would happen, that they would actually win. You know, he had a prepared speech, a losing speech. And now that they've won, there's going to be a lot of bureaucrats who are making six-figure jobs in Brussels who are going to be fighting this. There's going to be a lot of people in England who don't want to leave. I actually met in D.C. A young English adult couple that was recently married that was here visiting, and I met them out in D.C. and they were just totally upset that they had lost the vote. They wanted to be a part of the European Union. I could have mentioned all the facts and figures and economic data that would have benefited them from some type of independence, and how their purchasing power and savings were being stolen by Brussels and devalued by the European Central Bank. They wouldn't have cared. So this is the sentiment that we have, that people have to overcome this type of programming. So I think in terms of that, what I would say, though, is that Nigel Farage, he did an amazing job, even struggling, fighting to get this, and Boris Johnson and some of the other types there. But Nigel Farage has had to step away. And one of the reasons is because he got thousands of death threats from Englishmen who didn't want to leave. So him and his family and friends, he was getting threatened, to be killed. I just think the situation is just ridiculous in terms of, I don't think long term the situation will really help that much. I think the bureaucrats and politicians and central bankers running the Bank of England, even if Britain maintains full independence, and it's going to be really hard for them, Dave, to get out. It's going to take at least 2 years. I don't think it's going to do that good, because I think the people that would be making a lot of the decisions, they have the same training that a lot of the other central bankers in the United States, in Japan, in the European Central Bank, they have the same training as those guys. So they went to the same similar schools from the same professors for how to run a bureaucracy, how to run a government. So I think the taxes and the inflation, if England does get its independence, are going to be really high. What they need to do, if they actually do get their independence, they need to get their economy turbocharged. They need to cut taxes on small business and entrepreneurship. They need to encourage investments from foreigners to start building businesses again in England. Not these Wall Street investment banks that are going there to the city of London with loopholes so they don't have to pay taxes on it to do these crazy derivatives trades. That's not productive for their economy. Not the, real estate speculators and billionaires that are going there to park money in London to buy up the real estate prices so the average hardworking middle class families in London and other parts of England can't afford the real estate. So I think there's just so many misallocations of capital in their country. The monetary and fiscal policies of England, even as a separate country, are going to be difficult. I'm not sure how much independence it would potentially give them a chance to fix things, but I don't know how much it would fix things in the whole scheme of things, because the president of the Bank of England, Mark Carney, he's a hardcore Keynesian.
Do you think the central bankers allowed this to happen, where the referendum, they were able to vote to say, yes, we want to leave the EU? Do you think they did this to let air out of the bubble and to allow the central bankers to do things where it wouldn't be questioned, where they can say, oh, it was because of the Brexit, like we had to give a bailout to the Italian banks, we need to create more currency because of the Brexit? Do you think this was used for this purpose?
I don't think that was the initial plan. I don't think they thought that the people would actually vote for the Brexit. But I think they're going to hijack it, like you said. So I think they're going to spin it to their benefit, because they have plans, contingency plans, and outcomes and things like that in order to do this. So I think companies now, European companies who produce bad earnings, right, who don't beat their quarter, they're going to be blamed. They're going to blame it now on Brexit. They're going to say, oh, the exchange rate of the British pound caused our problems. You're going to hear people say that on conference calls, and you're going to hear, people blame Brexit for problems that had nothing to do with Brexit. So I think that's going to be the excuse du jour. It's going to be the same type of excuses that American companies have used when there's, the snowstorm that or Hurricane Sandy in New York and New Jersey that was blamed in the past, or snowstorms or things like that. So weather problems, the consumer didn't come out and shop at the malls. There'll be retail companies in the US in the past. They'll say, the consumer didn't come out and shop at the malls because the weather was bad for the last couple months. So I think, people are just grasping at lame excuses. And most people are not paying attention to the facts underneath the surface. And a lot of people will take the lame veneer of excuses that these elites give. I mean, we know that people nowadays, a lot of people on Main Street, unfortunately, are so dumbed down. People have book smarts. People may have a couple degrees, but in terms of common sense, you go up to someone and ask them, how much what's the gold price? What's the silver price? Would you take this 100-ounce bar of silver or a bar of chocolate? I'll take the bar of chocolate. We have a lot of people like that now who think that Bernie Madoff should be the vice president for Bernie Sanders when Bernie Sanders was still in the election. So I mean, the people will take the excuse that, this Brexit problem, because the media is talking about it so much, it must be so bad. That must be what's causing all the problems, ignoring the fact that the over-the-counter derivatives market, Dave, has been built up since the 1970s and 80s, compounding, at enormous growth rates, getting so large that, people can't stop problems or leaks in that system.
We hear the Fed out there, we hear the president out there, we hear the corporate media continually telling us that the economy is doing better and better. We see the stock market reaching all-time highs. What is your take on where the economy is going? Many people are saying that the economy might not even make it to the fall period. But what is your opinion on this?
Well, the economy is collapsing already in the real economy, but they still manage. This has been this way for a while. I mean, we haven't had much of a recovery since 2008. Now, there was a lot of oil and natural gas and oil service jobs that were created with the shale boom that has been going bust lately. A lot of those jobs, however, were just in North Dakota and Oklahoma and Texas. But a lot of the other states, Dave, really since 2008 in the United States haven't had much of a recovery. So I think this is just people on Main Street, they're going to get worse and worse. Things are going to get worse and worse for them. So there's going to be more taxes layered on, potentially a VAT tax in the next 10 years or online national sales tax. If you go and buy a burrito at Chipotle or another Mexican restaurant, you're gonna get an extra 8, 9, 10% tax. It's gonna be layered on. You're gonna be paying car taxes and all these other taxes, and that's how they're gonna be dealing with this. Besides just drastically trying to every country on the planet Earth trying to drastically devalue their currency. So this is the end game here. We are in the end game because we've gotten to ridiculous negative interest rates. This is the Keynesian end game. Trying to time the exact amount or say when the end game will actually occur is a fool's errand. I don't think it's worth trying to say, it'll be 3 months tops, or it'll be 6 months or 12 months. I think the last time I was on your interview, the last time or the time before, I said probably about 2 years, if I had to guess. They could still keep most people fooled, even after an election, even after another crash. Maybe they do one last, infrastructure print that gets some people back to work at maybe a minimum wage job or something like that. But people are starting to wake up, and they don't understand everything that's going on, but they're starting to notice some things. So they're noticing that, hey, wait a second, Hillary Clinton just, she committed all this stuff. The FBI director was on listing all the things she did. That sounds like she should have been charged and, gone to trial. And yet he's saying, it's just no big deal. But yet we have Corrine Brown, who's a Democrat congresswoman out of Florida. She did an $800,000 fake charity, stole lots of money. $800,000 is a good amount of money. And yet she's facing 300 years in prison for fake charity and wire fraud and all these other things. So why are people above the law? We are having some people wake up and notice certain things. Oh, hey, my bills for this and this and this, my rent bill's up, my healthcare bill's up. They are noticing these things, but they are placing the blame, though. They're blaming, it's only the evil, greedy corporation's fault. I hate capitalism, even though we don't really have full capitalism now, but they are blaming it on capitalism and corporations and private sector companies. But you know what? In a lot of cases, it's not all the corporation's fault. So yes, we do have large corporations creating cartels in certain industries. That's something I wanted to bring up. There's a lot of people right now that are saying, if we hadn't had Glass-Steagall repealed in 1999, then we wouldn't have any of the derivatives market problems or anything like that. Well, that's BS. Did the SEC catch Bernie Madoff as soon as he started his Ponzi scheme, or did they let him run it for over 10 years and, raise tens of billions of dollars in fraud? Does the FDA protect Big Pharma? Do they let bad drugs that Big Pharma knows will kill people or cripple them? Do they pass those drugs and then block good technology from small biotech companies? Do they block those so the Big Pharma companies either won't have any competition or they can buy out the intellectual property for peanuts? As a investor in that sector for a number of years in the past, I know that happens. I've spoken with people in the industry that tells me it happens. So I think we have a situation now where people are waking up. This is why Donald Trump is popular. This is why Bernie Sanders still is popular. People are recognizing there's a problem, but they're not understanding what's the solution and who's to blame for these problems. So if we do create more government agencies, if we do give government more power, I don't think this is going to solve things. Going back to Glass-Steagall, other points I wanted to hammer on. In terms of Glass-Steagall, the Wall Street banks were creating derivatives, Dave, starting these things in 1971 when the dollar's last vestiges of international gold standard were severed and money and credit exploded. There's a expert named Peter Warburton from London. You can read his article about this. It was written in 2001. It's on the GATA website. Search Peter Warburton 2001 on GATA website. Talking about the derivatives market and how, this thing was exploding to hide the inflation that all these governments were created. They were moving the monetary inflation so banks could make record amounts of profit into there for decades before Glass-Steagall was repealed in 1999. So Glass-Steagall, the banks were cheating in many, many different ways on Glass-Steagall. I could give you tons of different stories of the ways that the banks cheated on Glass-Steagall. So the banks that had the investment banks on Wall Street that had certain corporations as investment banking clients, they would recommend the stock was good when they knew that the underlying stuff of the company was going bad, or they knew that the trading department of their own firm had just made a lot of money off the stock in the last 5 years, and they would go on TV on Bloomberg or CNBC and tell the people, "Oh, research in motion, it's at $70 a share now. We think it's going to 100, right?" Where their trading department is going to dump all the shares, and they knew the stock was going to crash because the iPhone was coming out. So this is the legal theft that we have, the plunder in society. And so adding thousands of more, if I could give your listeners one last thing, adding thousands of more government bureaucrats to solve these things. There are some good government bureaucrats. I live right outside of Washington, D.C. that try to do the right thing, but they're heavily outnumbered by the ones that don't care, that don't want to do the right thing, that want to go work for the large corporations that cheat, that they know cheat for a higher salary, and they don't care what happens long-term to the system. So until we fix this problem with morality and corruption in the political system, and I think this would be solved with a smaller government, with the consumer understanding, caveat emptor, buyer beware, that the consumer has to understand that they're not going to have these government agencies protect them, and they can't trust government and government agencies to bail them out and do all these things. So hopefully your listeners will take away this, that more people are waking up, but people are placing the blame right now on the wrong entities. So I hope people will have an open mind and challenge their beliefs about who is to blame for what's happening right now, why everything is collapsing.
Jason, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work?
They can go to the main Wall Street for Main Street page. That's WLLSTFRMAINST.com, Wall Street for Main Street website, and our YouTube channel, which you graciously plugged earlier in the interview. That's WLLSTFRMAINST.
Thank you very much for being on the Spotlight once again. I appreciate it.
No problem, Dave. Keep up the great work.
You too. Thank you.